Hello everyone, this is Dr. Mahmoud Al-Odeh, and here in this video I'll be talking about depreciation methods, and this is chapter 10 of Economics and Cost Analysis, TEDT 3267. Another interesting topic about finding and predicting the value of an asset. It is a continuous for what we've learned from previous chapter. Previous chapter we talked about the asset market value and how we could find the market value based on replacement studies. In this chapter we will be talking about similar thing, but from tax purposes. We need to talk about the depreciation of an asset and how we could claim some tax credits based on asset depreciation. Let's go ahead and talk about the goals and objectives. After finishing this chapter, you will be able to define depreciation terminologies. Number two, you will be able to conduct depreciation analysis using the straight line technique. So we will learn about different depreciation techniques, and one of them is the straight line technique. Another one, we will be talking about double declining or declining balance. And a third one would be MACRS, the Modified Accelerated Cost Recovery System. Number three, you will be able to calculate the salvage value of an asset based on the depreciation value of its lifetime. Number four, implement the declining balance and double declining balance strategies to conduct depreciation analysis. Number five, perform depreciation analysis using the Modified Accelerated Cost Recovery System, and this is the IRS technique that the only accepted techniques by the IRS, and we were going to conduct that for different assets, including the real estate properties. All right. Introduction: depreciation is a measure that the amount, the tangible asset value has been used during the production of income. So this is basically, if you have an asset, the value of an asset will decrease by time. And also what you could do, you could take some benefits and take some tax deduction based on the value of the asset. Depreciation is used for tax and accounting purposes to reduce the value of these assets. The IRS, the Internal Revenue Services, has developed rules and guidelines for the calculation of the depreciation, including the rates and periods that apply to various types of assets. All right, let's go ahead and start with the terminologies. Terminologies: depreciation is the reduction of asset values due to its use in business operations. Depreciation rate is the reduction percentage. Now we're talking about the percentage here of an asset value to be removed from the asset value every year. Book value: the book value is the written value of an asset at the end of the year after deducting the depreciation percentage from the purchase price of an asset. So one is to find the depreciation rate. This is the first thing that we need to do, which is the percentage of reduction, and then find out what would be the reduction value based on that percentage, and subtract the value, take off the value, that value from the asset value. Recovery period: the time needed to depreciate an asset value and reduce its book value over time until the end of its life. There are different recovery periods for assets, and therefore the IRS developed the guidelines to help managers like you determine the recovery period of an asset. The last term that you should be aware of is the market value, and the market value is different than the book value. The market value, it is the claimed value of an asset based on an estimate of sales price if the asset were sold. Okay, there could be an asset with a book value of 0, but the market value is $1,000, for example. Here's a good example that we would like to share with you. A good example of this is the low market value that used laptops. So if you come up to the used laptops, you will have that the book value is low comparing to the book value. The opposite situation in real estate. You will have the book value of a building is higher than the book value itself. So the market value, it's identified by the market itself, by the demand of that asset. All right, now, as I mentioned, we have to, in this chapter, we will be learning about three types or three techniques of depreciations. One is the straight line, declining balance, and the modified accelerated cost recovery. And if you look into this chart right here on the right side of the slides, you will see the orange line is a straight line, which is basically reducing the asset value by a fixed amount. And now if we need to even decrease the value by percentage, that would be the declining balance. And in between these two techniques, the declining balance and the straight line, is the IRS technique, the MACRS, where they deduct the value of assets by a certain percentage. And so the difference between these techniques are the details on the way that the value of asset is reduced. Some of them, they take a bigger reduction in the value at the beginning of the early years, versus the other one will take just a few amount of deduction. We'll learn about these deductions or depreciation methods in this chapter, and we will use examples to demonstrate these techniques. All right, let's learn about the first depreciation technique. The first depreciation technique is the straight line, or SL. And this is the basic and the easiest depreciation method to reduce an asset value over its useful time. The simplicity of the straight line method comes from reduction the value of an asset by the same fixed amount every year until the end of its useful time. In order to determine the straight line depreciation of an asset, we need to determine the rate, the depreciation rate. And the depreciation rate can be calculated by using this equation, 1 over the recovery period. So if you have an asset with a 5-year recovery period, which means you use it only for 5 years, the depreciation rate would be 1 over 5, and that would be 20%. So basically you decrease the value of the asset by 20% every year. All right, now the next equation here would be the depreciation value. The depreciation value would be calculated by the initial cost minus the salvage value times the rate, the depreciation rate. Of course, Excel is an amazing software that we use. So there is a function for the depreciation in Excel, and that function is called SLN, equal SLN, open parentheses, initial costs, comma, salvage value, comma, recovery period. After finding the depreciation value, then you have to find the book value for the asset by subtracting the book value from the previous year minus the book value that you just calculated. All right, let's go ahead and start with the first example on the depreciation rate, and I'm going to switch to Excel here. All right, what you see here in front of you is example number 1. Determine the annual straight line depreciation value and the year-by-year book value for an asset that is purchased for $80,000 and has a salvage value after 5 years of $50,000. The answer for this would be doing the calculation, start with the rate, and the depreciation rate would be 1 over 5. Because it's the recovery period is 5 years. So that would give you a depreciation rate of 20%. So the depreciation value would be 80 minus 50,000 times the 20%. That will give you 6,000 every year to be deducted. All right. So on the left side here, you will see the table of the depreciation value. And what I used also, instead of using the equation, well, I used the SLN function. And I used 80,000, 50,000 for the salvage value, and 5 years for the life of this asset. And that would give you 6,000 as a depreciation value every year. Now for the book value would be the book value from previous year, which is 80,000 minus the 6,000. That would give you 74,000 as the book value for year one. On year two, we take the book value from previous year, 74 minus the 6,000. Year three, the book value of year three would be 68 minus 6,000. And then 56 in 56,000, this is coming from 62,000 minus 6, and you keep doing this until you reach the 50,000, which is the salvage value. Now, this number should match the 50,000 that is given to you in the question. If you did not receive that number, that means that you made some mistakes in your calculation. So you have to go back and review your your techniques and review your Excel sheets to verify that you have the correct numbers. All right, so that's about the straight line. So what we've learned so far, we've learned that the asset will reduce a value, and the value, it's a fixed amount, as you see, 6,000 in this example. And now in order to find a book value for an asset, we subtract the book value right here, which is basically 80,000 minus 6,000, or 74 minus the 6,000, until you come up with a salvage value, which is the last year of 50,000. All right. Now what I'm going to do is I'm going to move into the second technique, which is the declining balance techniques, but I'm going to create another video for that. So I'll see you in another video.